Crowe Horwath partnered again with Bank Director for the 2017 Bank M&A Survey. And based on the results, deal activity in 2017 will likely be consistent with the level experienced in 2016. This level is down this year compared to the number of deals announced in 2015. More respondents see a stagnant or less favorable environment for M&A compared to last year's survey. Consistent with previous surveys, there are more buyers than there are sellers in the marketplace. 46% of respondents indicate that they are likely or very likely to purchase a bank by the end of 2017, but only 25% are open to selling the bank, considering a sale, or actively seeking an acquirer. This mismatch has contributed to a lower deal volume and lower levels of optimism. If the new administration and Congress can enact regulatory reform, as many bankers believe will occur, then this could make remaining independent a more viable option in the view of many bank boards and management. However, while more than half of potential sellers cite regulatory cost as a reason to sell, 48% indicate that shareholders actively seek liquidity, and 39% limited growth opportunities. 15% of potential sellers haven't addressed succession for the CEO or senior executives. Regulatory reform won't directly address these deal drivers. So is it a buyer's market or a seller's market? It may seem like a seller's market since more banks want to buy than wish to sell. However, buyers' acquisition criteria have become more refined as a result of changes in accounting rules, economic circumstances, and regulatory areas of focus. Growth for the sake of growth may have been the old school way of doing acquisitions, but today's successful buyers are selective about what they are looking for in the banks they wish to partner with. In the survey, buyers rated the importance of several variables in their decision to make an acquisition. Respondents rated attractive markets and geography as highly important attributes in an acquisition target, followed by lending talent, a strong deposit base, and demonstrated loan growth. Successful acquirers have policies that are carefully crafted to identify the types of banks that are attractive to them and the markets that they wish to pursue. Less successful acquirers that pursued a strategy based primarily on achieving scale have ended up with unwieldy footprints and encountered difficulties in integrating acquisitions, which in reality didn't fit very well with their existing franchise. For sellers wanting to achieve the best price for their institution, there are areas that can be improved upon. If you're in a low-growth market, you can't really change that, but you can look for investments in higher growth markets through branches, loan production offices, or acquisitions. If these options aren't available, then the bank must maximize its position in the market and look for operational efficiencies to maximize the bank's worth. Potential sellers also need to understand the accounting, tax, and regulatory impact of decisions they make in the ordinary course of business, including vendor contracts and change in control agreements. Long-term or overly generous contracts can raise concerns on the part of the buyer. Deals fall apart for a variety of reasons, and the survey continues to show that potential buyers and sellers often can't come to terms on price. 64% of potential buyers who have walked away from a deal cite inflated price expectations, consistent with 72% of prospective sellers who say the proposed purchase price was too low. In looking at a comparison of price to tangible book value for the first 11 months of 2016, the prices achieved by sellers were slightly down compared to 2015. For many potential sellers, it's possible that this reversal of pricing has had a chilling effect on their appetite to sell. Additionally, 20% of potential sellers have walked away from a deal due to the overvalued stock of the prospective acquirer, indicating concerns about value erosion after the transaction, as the price of the buyer's stock seems unlikely to rise in that scenario. Culture mismatches also sink deals, according to 49% of potential buyers and 32% of potential sellers. Culture is difficult for potential acquisition partners to assess. While cultural assessment tools can be used to quantify these issues, deal partners often don't have time to complete an assessment during due diligence. Instead, buyers and sellers have to look for clues in the people and processes they encounter during negotiations. Credit quality has caused 54% of potential buyers to walk away from the deal. In the survey, 45% of respondents say they are beginning to see deterioration in loan underwriting standards. Should the industry be worried about future credit quality issues? It certainly captured the attention of regulators. Visit bankdirector.com for the complete results of the 2017 Bank M&A Survey and read an in-depth analysis in the first quarter 2017 issue of Bank Director magazine.